Right. Good evening, everyone. So, welcome to this online lecture on this auditing and assurance services. We had to conduct this lecture online today. So, we have started this lesson. Actually, that is session 6, auditing accounts, receivables, and revenues. We started discussing this topic last week in the physical lecture, and today we have to finish this lesson, and then I have uploaded the new lesson. We will try to start that as well. Right. So far we were talking about different auditing procedures, right? Now we were discussing about test of controls. That means we are testing the controls, and then further audit procedures done by auditors. And then I told you that there are different categories coming under further audit procedures, like different categories and different testing types are there. So we have discussed everything. And in this lesson, we were focusing on, now we selected one caption, one area from the statement of financial position, that is accounts receivables, and then from the profit or loss statement, that is revenue. So we have picked two captions, and then we were in the process of discussing how to do the audit. Basically, general understanding is there with us, the audit procedures and all. So we were talking about specific audit procedures to be conducted when it comes to accounts receivables and revenue. Right. And then I told you why we are picking revenue and accounts receivable. And if we are picking revenue, then why accounts receivable? Told you now revenue is a significant caption in any organization, because there can be accounts estimates, there can be complex revenue recognition points, and that revenue is the only positive figure, main positive figure in the P&L. So there can be manipulations as well. Because of that, revenue is very important. That's why usually when you are performing, when you are doing an audit, your audit senior or someone with experience is handling revenue and all. And then why accounts receivable? Because the other opposite side of revenue is accounts receivables. When if you take a double entry, when we credit revenue, if it is a debtor or like credit sale, debtors will be debited. So that is why both sides are important. If you want to manipulate revenue, manipulation is easy with credit sales, not cash sales, because we can't manipulate the cash figure easily. If we want, we can actually, but we can't do it easily. So that is why if we want to manipulate, increase or decrease revenue, we might credit revenue to increase the revenue, and on the other hand, we might debit trade receivables. So that is why it is important. So I told you, when it comes to accounts receivable, trade receivables is only one item, one main item coming under accounts receivables. There are so many other captions available coming under accounts receivable. Now there can be loans we have provided to employees, loans given to subsidiaries as well. So there can be receivables from different other parties. All are categorized as accounts receivables. So I told you trade receivables is only one part of accounts receivable. And then why the audit risk is high when it comes to revenue and accounts receivable. We have discussed this, right? And then I told you, before doing anything, coming under audit planning, also you discussed this aspect. We have to assess the risk. So when we are assessing the risk assessment, we are doing so many things to understand the nature. So I told you, first of all, you understand the client. Who is our client? Whether it is a new client or a continuing client, risky client, or a less risky client, a client with problems in the past audits, or client with smooth audit procedures, audit process. What is the nature of this client? Whether that client is doing a business in a very risky industry, like a construction industry, or just a consumer goods industry. Likewise, you understand the client. and its environment. Whether that client is in an industry where there are so many environmental changes, external pressures, political instabilities are there. Now, let's say we are doing an audit. Audit client is in an industry where there are so many laws and regulations changing, and there are inflation factors affecting, and there are exchange rate factors are there. So it's a risky environment. So you understand the client as well as the industry, laws and regulations affecting the client, if whether there are competitors in that, like whether there is a intense competition in that industry. If there's an intense competition in that industry, sometimes there can be manipulations as well. Because of the competition, they are trying so hard to survive in the market. Whether they have very powerful stakeholders. If so, they are trying to give a good profit number to their stakeholders. So in that case, there can be manipulations. So likewise, you understand the environment as well. Now, these days, if we take in the Sri Lankan economy with the world economic situation, world economic crisis, I would say, we don't have a crisis yet, but there can be with the changes in the uh, like fuel market and all, fuel prices and all. So if we take like oil companies these days, that is very risky because there are market price changes, demand changes, supply issues, and all. So we don't know. Inherently, that environment is risky. So that's why we need to understand when we are trying to do an audit, it's not only the revenue caption. If you have been allocated to audit the revenue, it's not only the audit caption, revenue caption. It's about the whole organization. It's about the client and it's about the environment as well. So you understand whether inherent risks are there, whether there are fraud risks. If there are some issues, now you get to know that there has been frauds in the past audit, found in the past audit, or during this year, your client's finance manager is saying there were some fraud indicators during the period. So fraud issues, fraud risks can be there. And then you understand point B, understanding the internal controls. So we have discussed the internal controls. You have separately discussed the internal controls. So you try to understand what are the internal controls they have over revenue and receivables, whether they have proper controls in place, whether they have designed the internal controls very well. We call that design effectiveness. And then we try to understand whether their internal controls are operating effectively. That means we call operating effectiveness. So we try to understand design effectiveness and operating effectiveness of those internal controls. So I have mentioned that sometimes organizations have internal controls, but they are not operating effectively. They are well designed. In the manuals, if you take the manual, internal controls are very well done, very well designed. But when you go and check the internal controls, they are not operating effectively. They are not following it. Top management is not just taking the internal controls seriously. They are not reviewing them. They are not concerned. So you try to understand the nature of internal controls. And then part C, assess the risk of material misstatements, risk of having material misstatements, and design test of controls and substantive procedures. So you try to gather evidences through two ways. You try to do test of controls, testing the controls, and then, if not, substantive procedures. So I have mentioned you will have to do both test of controls and substantive procedures in an audit. You can't 100% rely on test of controls, but you can 100% rely on substantive procedures. Likewise, I have discussed those combinations as well. Right. So then you are trying to understand by designing and by conducting test of controls and substantive procedures, you are trying to cover the assertions, existence of receivables, occurrence of revenue, completeness, cutoff, rights, valuation and accuracy, presentation and disclosure. Likewise, I have discussed these things. We are trying to cover these assertions. And then what are the things to be covered coming under internal controls? The control environment, the tone at the top, whether the top management is supporting the internal controls, whether there's a good control environment, whether the independent board is there, whether the board and the audit committee are independent each other, whether they are valuing the ethical behavior, whether employees are behaving ethically. Likewise, you try to understand. Right. And then we were discussing some documents, some general documents related to revenue cycle, right? Purchase order. Now we start revenue when we receive an order. So from the person or the organization placing the order, from their perspective, it is a purchase order. But from our perspective, company's perspective, it's a sales order. So once we receive the sales order, we might start doing the process the order. Sometimes we are processing or manufacturing for the orders we receive. Sometimes it's not the case. We generally, with the forecasted numbers, we are trying to manufacture the goods, but the sales happens when we receive an order. Without a sales order, we can't sell goods, right? So sales order is the initial point. And then bill of lading, if we are shipping the goods, that means we are exporting. And then billing, when we are billing, we are preparing the document called invoice. And then control listing to receive cash receipts. And then credit memo when we are authorizing adjustments. Now, for each and every credit, that means for each and every debtor, we are deciding, organization is deciding the credit limit. What is the credit limit of this customer? Are we allowing 200,000, or are we allowing 100,000, or are we allowing 1 million? If we know the person, if we have a good experience with him, if the history is good, we might allow for a good credit limit. But if it is a new customer, if that customer is very risky, if that customer has not paid the dues very well in the past, we might give a low credit limit. So likewise, credit memos can be there when we are changing the credit limit. So for all these things, there should be approvals, right? So, and then the revenue cycle. This is not a very perfect cycle, I would say. This is an example for a sales system. Once we take the orders, as you can see, we are documenting the order, maybe entering the details to the system, and then we are processing the order. That means making the order. Maybe we are receiving or taking the goods from the warehouse as per the sales order. And then when we are dispatching the goods, we raise the goods dispatch note, we raise the invoice, we send it to account, send it to the accounts division to account the invoice, and then monthly we are sending the statements to that client. These numbers are pending. Like if that customer has purchased, or that means three sales orders are there. That means three invoices are pending. We are preparing a statement, right? We are sending that statement to the customers. And then we are chasing the payment, that we are following up, and then we are trying to collect the dues. Right, that is how a usual sales system goes. And I mentioned you using a flow diagram also. We can show that flow chart with the starting point from the customer and then purchase order. So input sales order data to the system, and then we have to approve the credit limit as well. That credit limit approval should be filed in the customer's file. And then after the sales order approved, we are releasing the goods for the shipping. And then once we are taking the goods, input sales data and generate the bill of lading. Because we have taken this scenario, assuming that we are exporting the goods, right? Bill of lading and then shipping the goods, and then goods are received to sent to the customer. And at the same time, shipping file is updated and then bill of lading is sent to the customer. Likewise, there can be different stages coming into the different processes. And then risk assessment for the audit of receivables. Now, I told you, you need to understand the client and then its environment to consider whether there are inherent risks in this industry of this client, or whether there are fraud risks in this customer, in this client. Likewise, you try to understand. And then I told you there can be internal controls, and you try to understand the internal controls over the receivables and the revenue processes. And then you are assessing the risk of material misstatements. So, details on understanding the client. Now, I was talking about understanding the client and all. So, what are the things you need to understand about your client? Maybe the types of products and services sold. You are trying to understand what are the product types. Sometimes diversified organizations can be there. That means that company is selling goods or services in the agriculture industry, agro industry, paints industry, hospital industry, hotel industry, hospitality industry. Likewise, diversified holdings can be there. So you need to understand, when you do a revenue caption in such an organization, there are different revenue types, not just one type. So you need to understand, you need to have a good understanding about several industries. And sometimes simple organizations are there. They are operating in one industry, and then you have that particular goods. Now, when it comes to goods, even though it is one industry, there can be different types of products. Maybe the quantities can be, the sizes can be different, there can be flavors, different prices, different brands. Likewise, there can be so many product categories. So that is why inherently that is risky. If it is very rare to have one standard product for the whole country or whole market. There can be different variations. So you need to understand what are the types of products or services you are going to sell. And then the classes and categories of clients, customers. Now, you need to have a good understanding about the customers of your client. Sometimes local customers can be there. That means your client is selling goods or services to local customers. Sometimes international customers, that means foreign customers, that means exporting the goods or providing services online to foreign customers. Likewise, some countries can be there. Some branches can be there. Sometimes your customers are different. Sometimes your client is focusing on kids wear. Sometimes your client is focusing on women appliances and women wear, likewise, gents wear, if it is an apparel company. So different types can be there based on the gender, based on the age, right? Elderly products can be there, kids products can be there, different types can be there. So you understand your not your customers, clients, customers. So this gets very complex when you have multiple industries in your client, right? Because when it comes to agriculture business, let's say your organization, one branch of your organization is to sell agrochemicals to farmers. So your customer type is very different. Now, when your client is selling goods to those farmers, and then when they are planning market campaigns, discount campaigns and all, their strategy should be different. Their strategy should be aligned to the customer's requirements. But let's say that same company is having a five-star hotel chain as well, Agro business is one business, and at the same time, they have a hotel business, five-star hotel chain. So in that case, when the company is trying to develop market campaigns, that is totally different from farmers. So that's why you need to understand your customers as well. And whether the business is affected by seasonal or cyclical demand. I was talking about that last week as well. Some organizations, their revenue is not uh, like equal throughout the year. Sometimes that is cyclical or seasonal. Now we are in mid of or the beginning of March. So New Year season is coming. Now when it comes to hardware items, apparel, now if we take ready-made garment selling companies, their sales are going to be very high when it comes to March end and April because of the New Year season. And it will be same in the December season as well. So cyclical. And I told you I shared one of my experiences. Agrochemicals, I told you that there are demand for agrochemicals by the farmers that depends on the rainfall they get in Sri Lanka. When they are getting a high rainfall, their demand for agrochemicals are increasing because some crops can be manufactured during that rainfall season. So Yalamaha seasons can be there. As Sri Lankans, we know those things. So these things are their seasonal or cyclical demand. So you need to understand those aspects as well. Not just checking the numbers actually. If you are doing the audit procedures for revenue, you need to have that usual understanding in your mind. And then, what do you think about medicines? Do you think there's a cyclical demand for medicines? For some medicines, yes. For some medicines, actually, yes. But some medicines, it's not, right? No, usually, it's normal. Demand is normal throughout the year. But for some medicines, yes. Because I have another experience. One of my clients, when I was doing audits, that company was manufacturing some balms. It's a herbal balm. Now they were selling that herbal balm over throughout the year and also all around the country. Now, when it comes to Anuradhapura and Polonnaruwa, those two districts, their demand for that herbal cream or herbal balm increased when the farmers were actively engaged in farming activities. So that's a cyclical demand for that balm only in Anuradhapura and Polonnaruwa district because that has been their practice. That balm or the herbal cream is very popular among the farmers when they are actually farming, not in other periods. So that's why we don't know the season actually, but sometimes with the practices people are following, there can be seasonal demand for your products. So when you are analyzing, when you are doing an analytical review, month wise, if you take the district wise, month wise figures, you can clearly see when it comes to Yala and Mahakanna, those months, the demand for that herbal balm or herbal cream has increased. So it's a seasonal or a cyclical demand. And then typical marketing policies for the client and its industry. What are the campaigns they try to do? Usually their competitors are taking TV commercials, whether your client is doing the same. Now, is it normal to put big newspaper advertisements? Now, you might have seen some companies are doing advertisements, not TV, newspaper articles. They are taking the full whole page of newspapers. Sometimes small advertisements. Sometimes weekly they are publishing. Sometimes daily those advertisements are there. Sometimes only for the relevant months. Likewise, you are trying to understand their marketing policies, whether there are discounts available, whether it's normal to give discounts during certain periods, whether it's not. Likewise, they are trying to understand. And then policies regarding pricing, whether they are what is their pricing strategy now, whether it's a cost plus pricing method or competitor based pricing method. You try to understand the pricing as well. So those are important. That's why you need to ask these things from your client when you are trying to understand the system. You need to have an overall understanding about the whole system when you are trying to do an audit. The pricing as well. Pricing is important. Sometimes organizations are not changing these prices frequently. Once the prices are decided, that's it. It will be there for a longer period. But some organizations, it's normal for them to review the prices frequently and to do some changes. So you try to understand what is their nature. Now, let's say over the past 5 years, there were no any price changes, but during your period, they have changed the prices maybe 4 times. So you try to understand what has happened over the period. They didn't have a practice to change the prices, but what has actually led them to change the prices 4 times during one particular year? Sometimes because of the environmental changes. Now, we didn't know that COVID-19 is coming, but with the COVID-19 impact, companies had to do so many new things that they haven't done before. So likewise, you try to understand why. Always trying to understand the question, trying to ask the question why. And then what is their policy regarding sales returns? Whether they are just accepting the sales returns, sorry, or whether it is normal to have 10% sales returns from their annual sales. Whether what is their process, whether they are investigating the reasons for the sales returns. Now, I told you once, if the directors or managers want to increase the sales figure just to obtain their discounts, which is related to their sales targets achievements, to increase the revenue, they can just post or they can ask one of his friends to make or to put a sales order, and then when the company is selling that good, it can be revenue credit, debtors debit. It's obviously not cash sales, it is credit sales. So your director has asked one of his friends to do the or to purchase something from the company, and after 2 months slowly they are trying to return the goods. So it's just a reversal of the sales double entry. So we don't know the actual reason behind returning the goods. So whether there are physical damages, whether there are issues, why is this? Now, sometimes because of the faults in the goods, sales returns can be there. If there are so many faults around, like if we take one batch of goods, if there are issues, faults, damages in that malfunctions in that batch, that whole batch will have to be returned. So I think you have those experience. I heard, I can't remember the vehicle type. Recently there was an issue with one of the vehicle brands as well. They were calling all the vehicles they were sold as returns. And then discounts, extension of credit, whether it is normal to extend the credit limits, and whether what is their normal delivery patterns, whether what are the payment terms, whether they are accepting cash sales, whether they are accepting credit sales, whether they are accepting cards, Visa cards, Mastercards, that means credit cards, whether they are accepting online transfers, checks. All these things you need to understand. So I think client understanding is very important. This is well before you do anything. But this is before you understand or do analytical reviews and all, you try to understand the client first. This is one of your first steps before you do the audit procedures. And then compensation arrangements that are based on recorded revenue. Now, whether companies or clients' revenue is linked with any bonus scheme of the company. If so, who is getting this bonus based on the revenue achievement? Now, let's say if the directors are getting a bonus at the end of the year based on the revenue figure, definitely, inherently, there is a risk. What is the risk? Your directors might or they will try to change or manipulate the revenue figure just to get the bonus. Sometimes I'm not saying 100% correct, but sometimes there can be a tendency that they are trying to manipulate the figures. So that's why compensation arrangements are there or not. You try to understand that. And then typical revenue recognition principles used in the industry, how the clients, competitors, industry members are trying to understand the revenue, trying to recognize revenue over the period, and how your client is recognizing revenue. Revenue recognition point is very important because as the auditor who is responsible for revenue caption, you have to understand that revenue recognition very well. You need to have a clear understanding about that as well. So that is why revenue recognition principles are important. When it comes to SLFRS 15, you need to apply that knowledge into those basic understandings. Right. So that is how you try to understand your client's business. And then fraud risk related to receivables and revenue. That means you try to understand whether there is a fraud risk. Understand control established by management to control risk. What are the controls they have? What are the controls they have put to reduce the risks? And then determine controls have been implemented, whether they have controls, whether they have implemented the controls, because most of the frauds can be prevented when the company or the client has good controls. So that's why you try to understand the controls. If they have good controls, at least fraud risk can be lower. But let's say when you try to understand the controls, sometimes there are no controls at all. So at that time, there's a high risk of fraud. But sometimes there are controls, good controls, but they are not operating effectively. Again, what? Fraud risk is very high. Sometimes they have good controls, and when you check the controls, they have the operating effectiveness is there, very good. So in that case, there's a low risk of fraud. Fraud risk would be lower, but that doesn't mean there are zero frauds. I'm saying fraud risk is lower. So you can have that judgment when you try to understand the controls. That is why controls are very important here. Responses to risk. Now, after identifying the fraud risk, you try to understand what is the overall effect on audit. Now, not only revenue, not only trade receivables. If the controls are not good over the revenue, that means fraud risk is high. That might have an effect on the overall audit. And then all to the design of audit procedures. If the audit fraud risk is high, not only in revenue or trade receivables, but other captions, you will have to change the audit procedures. That means we were discussing 7 audit procedures, right? Basically, you were planning to call confirmations and you were planning to inquire some people, knowledgeable people in the industry, in the company. Those were the 2 audit procedures you were planning. But once you get to know that the fraud risk is high in your client, you try to do more audit procedures. You will inspect the documents, you will observe the processes, you will recalculate, you will reperform. Likewise, you are trying to increase the audit procedures. And at the same time, I told you, when you realize that the risk is high, you always try to increase the sample size. Previously, you were planning to go ahead with 25 invoices, but now you are trying to go ahead with 35 invoices, 40 invoices like this. And then performing procedures to address risk of material misstatements due to management override of internal controls. You perform more and more procedures to overcome the situation, to reduce the risk. That means if you try to understand, if you realize that the risk is high, then your main focus should be to reduce the risk. So to reduce the risk, what you should do? You need to do more audit procedures. You need to increase the sample. Maybe you will have to modify your audit opinion as well at the end of the day. Right. And then these tables, actually, this is very good. Potential misstatements. Now, if you just study this table, first thing is description of the misstatement. What are the possible misstatements? Potential misstatements coming under revenue. And then there are examples in the second column. There are two sets of examples for each potential misstatement. Some are frauds. That means intentional. Some are errors. Those are unintentional because of the negligence and human errors and all. So intentional and unintentional, both examples are there. And then the third column, it says internal control weakness. That means, or factors that increase the risk of the misstatement. What are the internal control weaknesses that are leading to these misstatements? You try to understand both, right? Okay, so we'll go with one by one. First one, recognizing revenue not yet earned. Your client has recognized revenue that has not earned. That means unearned revenue recognition. Your client has not earned the revenue yet. That means performance obligations have not met yet. But your client has recognized the revenue. So what are the fraud examples which are frauds? Recording fictitious sales without receiving a customer's order or shipping the documents. You have not received a sales order, you have not shipped the goods or anything, but you have recorded fictitious sales. Fictitious sales are more related to frauds because you know that there's no genuine sales order like this, but you are trying to recognize revenue just to improve, just to increase the revenue number. So maybe directors or managers involved in these cases because they want to increase the revenue number just to get their bonus. So that is only one example. Just to not only for bonuses, just to show that the company is performing well, just to show that the company is performing well to the external parties, just to increase the profits. Likewise, you are trying to record fictitious sales. And then intentional overshipment of goods. You know that the genuine one of your genuine clients, they have ordered 100 kilograms, but you are intentionally overshipping 50 kilograms more. That means 150 kilograms you are trying to ship because you can raise the invoice, and then at the maybe more towards the end of the period, when you do such intentional overshipments, your revenue will be recorded for 150 kilograms. But once the invoice is there, received by the client, your customer, and then customer is complaining that there's an overshipment. So after some time, at least after 2 to 3 days, this issue will be informed to the business, and then business will try to understand what has happened. So it will take at least 2 to 3 days to resolve the issue. Once by the time they resolve the issue, year end has passed, revenue has recorded. So they wanted to achieve the high revenue, mainly most towards the end of the year. These things can happen. So they have that the parties who wanted to increase the sales, their target is achieved. So likewise, those are the frauds. Then what are the internal control weaknesses? Why companies are having these kind of issues? Ineffective board of directors, audit committee, or internal audit function. That means tone at the top, not conducive or to ethical conduct, or under pressure to meet sales targets. Some people, they are under pressure to achieve the sales targets. Some board of directors, auditors, audit committees, auditors in the sense internal auditors, they are very weak. They don't understand what is the importance of internal controls. They are not reviewing the internal controls. They don't want to implement or design good controls. They don't take it seriously. So ineffective. So board members, they don't care. Audit committee, they don't know how to do this. Internal audit function is not doing their job properly. So those are the internal control weaknesses. And take the errors. What are the examples? Now, unearned revenue recognition. What are the errors? That there can be some errors as well. That means unintentionally. Recording sales based on the receipt of orders from the customers rather than the shipment of goods. So there's a point of issue in the revenue recognition. As accounting students, you have learned SLFRS 15, even Pub and ENT, you have learned SLFRS 15 in your year one, I think. So in that case, performance obligation is very important. Meeting the performance obligation when you try to recognize the revenue. So when when the client is recording revenue, once they receive sales order, that's completely wrong. They need to record the revenue when they are shipping the goods. That means when the performance obligations are met. So recording sales based on the receipt, that's an error. Sometimes if they are doing it intentionally, I would say that is a fraud. But sometimes the trainee, there are some trainees in the sales division. Trainee doesn't know this revenue principle. That person doesn't know the accounting treatment very well. Sometimes unintentionally these things can happen. So in that case, those are categorized as errors. And inaccurate billing and recording of sales. Mistakenly, you have entered a wrong number to the system. Recording cash that represents a liability. That means receipt of a customer's deposit as revenue. Sometimes customer has paid an advance. Advance is not a revenue. When you receive an advance, double entry should be cash debit, advance credit. Advance is a liability because you are liable to pay that. But mistakenly, you are crediting that advance not to the advance received account, but you are crediting that to revenue. So in that case, if it is unintentional, that's an error again. So what are the internal control weaknesses leading to these errors? Ineffective billing process in which billing is not tied to shipping information. When you are billing, that means I told you, when the sales invoice is raised, always two documents should be checked. That is why we call it three-way matching. You need to match the sales order, original order we have received, and then we have to match the GDN, goods dispatch note. So in that goods dispatch note, you try to understand what are the items you have dispatched, what is the quantity, what is the type, what is the price and all. Based on the sales order and the GDN, your company should raise the invoice. That is three-way matching. But if that internal control is missing, ineffective billing process is there, that's an internal control weakness. And at the same time, ineffective controls for testing invoices or ineffective input validation checks and compute reconciliations to ensure the accuracy of databases. So there are problems in the databases or systems, maybe. That is another internal control issue. Inadequate accounting manual, incompetent accounting personnel. That is what I was telling. When the accounts division, they have trainees, there can be issues like this. So trainees doesn't know the revenue recognition, the real accounting treatment. There can be issues like this as well. Right. So I think we discussed one misstatement. This is how you try to understand. Now I'm not going to discuss all the misstatements. Now you have the understanding. I will just quickly go through. Second misstatement would be early or late recognition of revenue. That means your sales revenue is genuine, but there's a problem with revenue recognition. That means cut-off problems. Maybe that revenue should be recorded in 2024, but you have mistaken recording it in 2025. Maybe that should be recorded in 2025. You are mistakenly recording in 2024. Those are cut-off issues, problems in recognizing the revenue in the correct accounting period. So what are the frauds? holding the sales journal open to record next year's sales as having occurred in the current year. If you want to increase this year's sale that is happening more towards the end of the year, you are trying, let's say 2024 figures are not good. So you are trying to record some 2025 transactions also in 2020, 2025, so 2024, this year. So you are trying to keep the sales journal open just to grab some 2025 new year sales transactions. So that is a fraud. Errors can be there, recording sales in the wrong period based on the incorrect shipping information. Sometimes, when the sales executives are checking the documents and all, with some issues in the dates of the shipping documents or the invoices, they are trying to record. They are trying in the sense they record the sales transactions in the incorrect period. So those are errors. Those are not intentional. So again, what are the internal control weaknesses? As we mentioned, ineffective boards, internal audit committees. Basically, the tone at the top is not good because the top layer is not considering the internal controls uh, seriously. And then ineffective cutoff procedures in the shipping department. If the procedures for shipping documents, putting the dates and all, if ineffective, there can be internal control weaknesses as well, which are leading to some errors. So those are some two potential misstatements in the revenue cycle. And when you see the third one, recording revenue when significant uncertainties exist. Let's say overstating revenue by underestimating the effects of customers' right to return goods. Now, you know, when there's one particular sales, you have dispatched the goods as well, but there's a high level of chance, there's a high level of tendency that these customers might return the goods. You know that because there were some price disputes, quantity disputes. You know it that these customers will return the goods for sure. But having those uncertainties, you are trying to overstate the sales revenue. That is a fraud because that is having known the situation very well, you are trying to overstate the revenue. There can be errors as well. Recording sales when the customer's payment is contingent upon the customer receiving financing or selling the goods to another party. That means you know that this customer, once that customer has received the goods, that customer will again sell the goods to another party. Based on that sales, your cash or the payment will be received. You know that, but you are recording sales when that customer payment is contingent. Still, that contingent payment is there, but unintentionally you just record the sales. So in that case, again, it can be considered as an error because there's no intentional misstatement here. It's an unintentional error. So, and then recording revenue when significant service, that means performance obligations, still must be performed by seller. Sometimes when you are making sales, there are components. Let's say you are selling an AC machine, your company is selling AC machines. When you are selling AC machines, there are several components in that sales order. You are selling the AC machine, that is good. And then the second one is installing services, maybe 1 year service, second year service. Likewise, there are several components. Issue is recording revenue when the performance obligations have not been met yet. That means customer or the client has actually paid the full amount, but the company can't recognize the full revenue until you fulfill the revenue recognitions. So that's why recording franchise revenue when the franchise are sold, even though an obligation to perform significant services still exists, intentionally you record it. Or sometimes there can be errors. Amount of revenue earned on franchise is miscalculated. Mistakenly you understand. Mistakenly you record the revenue. That is unintentional, that is mistakenly, but sometimes there can be frauds as well. So likewise, you have some misstatements, and another one would be overestimation of the amount of revenue earned, overstating the extent of performance on several contracts by a computer software company. This is where we sometimes, when it comes to software projects, sometimes construction projects, when it comes to those companies, revenue recognition is inherently risky. I told you that because of the nature of the business, nature of the industry, projects. Now, when we are pricing, when we are trying to give a value for the projects, contracts, and all, those are very vague. We don't have the exact figure for that. So you are trying to overstate the performances or overstating the extent of performance on projects by a construction company. As I mentioned, in the construction company also, actually they have completed 30%. But sometimes if they want to manipulate the numbers for a better picture, they will say, we have completed 45% of the whole project. So based on that completion ratio, they might record the revenue. That is an fraud. What are the errors? Overestimating revenue earned due to unintentional misapplication of revenue recognition policies associated with complex sales contracts. Unintentionally, when you are trying to apply the completion rates and the numbers, you get the numbers incorrect. So that is unintentional. That is why we call it an error. So likewise, those are the issues. There can be issues likewise in the revenue cycle. You need to be very careful. Sometimes when there are fraud indicators, that that will lead you to think that there can be frauds in other captions as well. When there's fraud in one caption, definitely, there can be frauds in other captions as well. There can be impacts on expenses. There can be impacts on payables. Likewise, there can be issues. So, whether you need to understand when there's a misstatement, when there is an issue, you need to understand whether this is a fraud or whether this is an error. If it is a fraud, what are the things to be conducted? If it is an error, what are the audit procedures to be done? Likewise, you need to understand whether the frauds and errors are there. And then additional test of controls you need to do. Now, I was telling you need to understand the controls. You need to check the design effectiveness. You need to check the operating effectiveness. And you are testing the controls, test of controls. So you do now. We were talking about letters, right? We were talking about ABC. A is trying to understand the client and environment. So we did that. And then we understood the internal controls, what are the controls they have. And then we assess the risk and we design test of controls and substantive procedures. Those are A, B, and C. So now, letter D, that's how you do it. Letter D, now you are trying to perform the audit procedures. Now we designed the audit procedures. We decided what to do. Now we are performing, right? So coming under that, you perform test of controls. You try to test the controls. Examples of test of controls. What are the examples? Examine significant aspects of a sample of sales transactions. That means you are trying to get the full list of invoices, maybe, and then you pick a sample and then you examine the significant aspects, whether they have checked, whether they have verified the invoices. Likewise, you are going to check. Compare a sample of shipping documents to related sales invoices. That is, you are trying to test whether the customer has done three-way matching. Now you are trying to get the shipping document. Maybe you are collecting a sample from a shipping document. Now you are trying to see whether the company has actually verified and matched the sales order, the dispatch note, and the invoice with the shipping document. So you are trying to understand whether there are signatures, whether there are some ticks, whether there are some approvals, or any evidence to see whether they have done three-way matching. If you can remember, we are not matching the documents now. We go and see whether they have checked whether they have matched the documents coming under their internal control. And then review the use and authorization of credit memoranda. Now, when they have credit approvals, when they have amendments to credit approvals, you go and see whether there are proper approvals, whether they have taken the approvals from the appropriate parties, whether they have checked, whether they have signed, whether they have kept a seal, whether they have kept a note. Likewise, you go and collect evidences to see whether they have done the internal control properly. And then reconcile selected cash register tapes and sales tickets with sales journals. You are trying to take some transactions from the sales journal, and then you are going to cross check with the documents. And then testing IT application controls. There are IT related controls as well, whether they have passwords into the system, whether accounts, whether that password is same for all finance personnel, or whether they have different passwords and usernames for different parties even in the same finance division, whether they are sharing the passwords among friends. Likewise, whether they have CCTV cameras in place. Likewise, they are trying to test the IT related controls as well. And examine evidence of review and approval of revenue estimates. If they have done some revenue estimates, now you are trying to see whether they have taken the approvals, whether someone has reviewed. Let's say sales executive or junior sales executive has computed the estimation, but whether someone has actually reviewed it. That is the internal control. So you are going to see whether someone has actually reviewed that one. That is the test of control. So these are some examples for test of controls. And then if necessary, revise the risk of material misstatements based on the results of the test of controls. So I have told you, after conducting the test of controls, if the if you understand that the test controls are operating effectively, you can trust. You can reduce the uh, substantive audit procedures because you are trying to rely on the test of controls. Let's say after conducting the test of controls, you realize their controls are not good at all. So you try to increase the substantive procedures. Sometimes you will have to assess, you will have to revise the previously assessed risk as well. Previously, you thought this is a less risky client because everything was in order, no problems, so less risky client. But after understanding the test of controls, after as the based on the results of the test of controls, sometimes you will revise the risk of material misstatement. Now you understand your client as a risky client. There can be revisions like that. So throughout the audit, not only in the planning area, throughout the audit, there can be revisions to the risk of material mistakes. Right. So these are some relating controls. And then I have given the control, and then I have given the test of control. There can be controls placed by the client. And then we go and do the test of controls as like this. And then what are the assertions we are going to cover by doing these test of controls, right? So I will explain. Before that, I will have a 2 minutes break, water break. So I'll be back after 2 minutes. Until I come, you can read this slide. Right. So we'll continue. Okay, so now in this table, we'll see what are the controls they have put, like client, possible controls to be implemented by the client. Maybe they have segregate duties over sales and collection of receivables. That means one person is recording the sales order details to the system, and another person is responsible for the collection of receivables. Basically, segregation of duties. Now, how are we going to test this? Whether the client has actually segregated the duties. Maybe we are observing and making inquiries about the performance of various functions. So you go and ask who is performing this task, who is responsible for this task. Likewise, you go and inquire. That is one thing. So I told you inquiry is good. Inquiry should be done always, but we can't 100% rely on inquiry as well. So that is why we can observe it as well. We are trying to see whether the client is actually doing. A second. Whether the client is actually entering the details by someone else or performing or collecting the receivables by someone else. So you go and observe and then make inquiries. So that will lead to the covering of several assertions, I would say. When you are trying to understand that, sometimes occurrence is covered because when they have proper segregation of duties, that means we can think that the sales records are accurate, sales are happening, whether genuine sales records are recorded in the system and all. So occurrence from the revenue side, uh, existence assertion coming from the trade receivable side. And then completeness, whether they have recorded all the sales transactions that should be recorded, completely recorded or not. But that doesn't mean we can cover cutoff because just by having the segregation of duties in the organization, that doesn't mean they are recording it in the correct accounting period. That is something else. So we are not covering cutoff. Rights and obligations we can be, whether the sales are genuinely recorded or not, because two parties are there. We expect them to work independently. We expect them not to involve in collusion. So I told you the opposite side of segregation of duties is collusion. That means employees get together and do intentional misstatements. So rights and obligation is also covered. And then since two parties or more than one party is involved in the process, we can be sure that their numbers are accurate. That means accurate numbers are there in revenue, and then trade receivables, the numbers are there. That means valuation is correct. So likewise, you can expect these assertions to be covered when you have this control, and then by performing this test of control. And then when you go to the second control, match sales invoices with the shipping documents, purchase orders, and sales orders. So that is why three-way matching always customer is matching the documents. So how are we going to test the control? Select a sample of sales invoices and compare details to shipping documents, purchase orders, and sales orders. You don't do the three-way matching from the beginning. You go and check whether they have done three-way matching. Maybe you are selecting a sample and you check whether they have mentioned that this three-way matching has done, whether they have put some notes, whether they have put some signatures to ensure that they have done the three-way matching. Likewise, you check. So again, occurrence and existence can be there, and then cutoff, because when you match the three documents, three-way matching is done. Most probably, you are recording your sales in the correct accounting period. And then, most probably, you have a right, the company has a right to record the revenue, and then the values are correct. That is why these assertions are covered. And then, there's another control, review of the numerical accuracy of sales invoices by a second person. That means the mathematical accuracy and all. So select a sample of sales invoices and examine them for evidence of second person review. You go and pick a sample, you don't do the mathematical calculation again and say that is not the test of control. That control is a second person comes and do the mathematical accuracy. So you go and check as the auditor whether a second person has actually mathematically calculated the invoice again. So when someone, a second party is doing that, there should be maybe a seal, maybe a signature with a date, second review done likewise, a note. So you go and collect that evidence. That again covers the accuracy or the valuation assertions of revenue and trade receivables. And then obtain credit approval of sales prior to shipment. Basically, that is a control. When you are when prior to the shipment, definitely you need to take the credit approval. What is the rest of control? Make inquiries about the credit policies. You first of all you try to have a chat with the maybe credit control or the finance manager to understand the process and select a sample of sales transactions and examine evidence of net approval. Whether there are evidences to see, whether there are board minutes, whether there are meeting minutes, whether there are some reports filed that these people, that these customers have been given these credit limits and all. So you go and check the evidence. And then mail monthly statements to customers and follow up on errors reported. Monthly, you are going to send the statements to the customers. So I told you when there are multiple invoices pending from a customer, you are trying to prepare a report, kind of a statement with the sales invoice number, with the details, the amounts, and all. So that shows the total amount due from a particular customer. So you observe and make inquiries about the mailing of the statements and review the evidence of follow-up, whether they have prepared the statement, whether they have emailed the statement, whether they have properly followed up. Likewise, you are going to check them. So that is how controls are there. And then another control can be reconcile bank account monthly. Maybe clearly they are reconciling the bank. Not this is not the bank reconciliation statement. Usual bank reconciliation when the customers are paying or transferring money to the banks directly. You are trying to reconcile the bank statements and try to understand whether all the cash receipts have been properly recorded. So you review a sample of bank recs performed during the year. So basically, you go and check whether the client has reviewed the bank recs prepared. That is the test of control. And then use control listing to control cash collections. The customer is preparing a control listing for the cash collections. So you go and check, you observe, or you are making inquiries about the process. How are they going to do this? And reconcile selected listing to a bank and accounting records. And then use budgets and analyze variances from actual amounts. If the customer is preparing budgets, that the customer, it says client, your client can prepare variance analysis. So I told you, you can take the budgeted numbers into one column and then you are trying actual numbers in another column. Now you are trying to compare budget figure versus actual figure. So likewise, you are trying to get those things. So examine budgets and evidence of follow up on variances. So you are trying to understand whether there are evidences to see that client has actually done that variance analysis. You are not going to do that variance analysis. You go and see whether client has done that actually. And then use pre-numbered shipping and billing documents. This is very important. Now, when the customer is having, let's say, even in the systems, this can be done. Or in the physical, just imagine a physical invoice book, hard copies of invoice books. Now there are numbers, sequential numbers. What is the importance of having sequential numbers? Basically, the main auditing assertion covered by sequential numbers is the completeness. Now you are going to check whether the client has missed any document. How can you check that? Number one is there, number two is also recorded, number three is missing, again number four is there. So you are going to check whether there are any missed invoices. That's why sequential numbering is very, very important. Remember, always pre-numbered invoices, pre-numbered shipping documents. That means sequential numbering of documents is important to collect evidences on completeness. And then use credit memos for authorization of adjustments to sales and receivables. So when there are any adjustments to sales, credit memos should be there. So select a sample of credits to customers, accounts, and inspect the credit memos and other supporting documents. You are trying to see whether they have prepared the credit memos, whether these credit memos have been approved properly. Likewise, you are going to see. Use a chart of accounts and an independent review of accounts classification. So you go and inspect the chart of accounts and evidence of review of accounts classification. So you don't classify the accounts. You just go and see whether your client has actually reviewed the account classification. So always controls can be there. Controls can be anything. Controls are not universal. Those controls can be different from organization to organization, industry to industry. But for each and every internal control, you can do a test of control. You go and check whether the client has actually performed that control. That is the test of control. So I told you previously as well, if you understand that your controls, that the companies or your clients' test of controls are good, then that means you don't have to do many other audit procedures. So basically, you can reduce the substantive procedures you are going to do. What are the substantive procedures? Test of details and substantive analytical procedures. That means TODs and SATs. You can reduce them. But let's say based on the test of controls, you understand that the internal controls are very weak. There's no operating effectiveness. Then you will have to do more TODs and more SATs. That is the relationship between test of controls and the substantive procedures. Right. Now, letter E. Now we have covered A. You understood the client and the environment. B. You understood the controls. C. You designed the test of controls and the substantive procedures to cover the assertions. D. You perform test of controls. So what do you do first? Test of controls. After performing all the substantive procedures, you don't do test of controls. So that's why I told you, you do test of controls first. After conducting test of controls, based on the results of the test of controls, now you understand, now you decide, okay, how much, up to what extent I'm going to do the substantive procedures. So now you are performing substantive procedures. What are the substantive procedures? You can list down so many substantive procedures. Maybe obtain an aged trial balance of trade accounts receivables and analyze of other accounts receivables and reconcile to ledger. Basically, aged trial balance means aging report. Don't know whether you know the aging report, so I will show you one aging report. This is an example. These are the customers. You list down all the debtors in the first column and you write the total due amount as at a particular date. Now, this is as of August 31st, 2019. This is an old picture. So you record the number, total value. And then you are segregating or dividing this total number into different baskets. You call that baskets. Current basket, and then 1 to 30 days old basket, 31 to 60 days old basket and 61 plus days old basket. Current basket means these amounts are not overdue. These are still within the credit period. That means, let's say we have given 1 month for ABC company to pay the dues. That means credit period is 1 month. So 59,121 amount that is still in 1 month period. That is not overdue, not overdue, the current bucket. But if we take the balance 3,335, that is 1 to 30 days, 1 month overdue. That means it has passed the stipulated credit period and then 1 month delay. And then look at this one, extreme company. Total value is 18,210. That is the total receivable amount. That is not in the current bucket, 1 to 30 bucket, 31 to 60 bucket, but it's 61 days old. So it's very, very overdue. And then main company, total receivables amount is 48. And then it's not overdue at all. It's in the current bucket. So that is within the correct credit period. Let's say we have given 1 month. That means let's say we have given 2 months. That's okay. It's in the current bucket. And then this one, the fourth debtor, I would say, total receivables is $1,200. It is 31 to 60 days overdue. So likewise, this is the aging analysis. Every company, they need to prepare this aging analysis and to understand what is the nature of their total receivables. Some receivables are healthy. It's healthy to have trade receivables, but some are not. What about extreme company, the second data? That's very bad because based on these buckets, based on these bucket analysis, you will have to provide for what? Allowance for doubtful debts. That means there's a high tendency that this extreme company, your second debtor, would not pay this $18,210 to the company. So most probably this will be a bad debt, right? We will have to write off that amount. So that is why this aging analysis is important. So that's an example. Obtain the aging analysis and you are trying to understand, you are going to reconcile that. So that is not a test of control actually. You get the age analysis from the client and you try to understand how they have performed the age analysis, and you can do several other audit procedures on the aging analysis. That's not a test of control, but a substantive procedure. And then the second one is confirm receivables with debtors. What do you call this? Calling external confirmation. So as we have discussed the 7 audit procedures, one of the audit procedures would be calling external confirmation. So you are trying to call confirmations from the debtors. So that's a very reliable audit evidence, I would say, because it's not that you are inquiring the internal parties in the organization, but you are directly contacting the debtors and then you are trying to get the numbers from the debtors. So calling confirmations, that comes under substantive procedures. Now if I ask one question, calling confirmations from debtors, is it a TOD or a SAP? Let's see whether there are 27 students in this class. Calling confirmations from debtors, is it a test of detail or a substantive analytical procedure? That means whether it is a TOD or a SAP. What do you think? Can I have the answers? Okay, මට පේනවා. All right, at least. I'm asking the question again. Pubuduni, you can answer again. When we are calling external confirmations from the debtors, that means we are sending a request letter to the debtor to confirm the amounts they have to pay to the client. That means basically we are getting a confirmation from the debtor. I'm asking whether it is a test of detail or a substantive analytical procedure. Exactly, TOD. Very good. Thank you for the answers. Right. So TOD, right? It's not a substantive analytical procedure. Analytical procedures means what? Simply starting from a simple comparison from previous year to this year, doing trend analysis, comparisons, expectations, and all. Right? So all other audit procedures are TODs, test of details. Very good. And then third one, review the year-end cutoff of sales transactions. Basically, you try to understand whether sales transactions have been recorded in the correct accounting period. How can you do that? There are different ways to do this. One simple way would be you take, let's say your period is from 1st January 2025 to 31st December 2025. So from the year beginning, that means 1st January 2025, you are trying to pick the first 10 invoices. That means, let's say you have a 100th invoice on 1st January 2025. So you are going to pick 90, 91, 92, 3, 4, 5, 6, 7, 8, 9 until 99. And then that is the first 10 before 1st January 2025. And then you are going to pick 101, 102, 103, 4, 5, 6, 7, 8, 9, 10. That means the next next 10 invoices after 1st January 2025. Altogether, there are 20 invoices. So you go and inspect the sales invoices and you check the invoice date, and try to understand whether those invoices have been recorded in 2024 or in 2025 in the correct accounting period. You do the same for year end as well. Let's say year end, last invoice number is 250. So you are going to check 250th invoice, 249, 248, 247, 46, 5, 3, 2, 1, 240. And then again you go back 251, 252, 3, 4, 5, 6, 8, 9, and 260. Likewise, before and after 10 invoices, most recent 10 invoices, you are going to check from the year beginning and year end. Then you go and check the invoice number, then checking whether the invoice have been recorded in the correct accounting period. Trust me, there can be some cases. Let's say 250 is the last invoice number in the system. But when you go and check 251, it has been recorded in the next year. But ideally, based on the actual dates and all, that should be recorded in 2025. Or sometimes, when you go and check 244th invoice, that has been recorded in the 2025 year. But ideally, that should be recorded in the next year. Maybe directors and the management, they have decided to record that invoice in the current year just to increase the sales revenue of this year. So you are going to do that cutoff test. That is how you do the cutoff test. That's another test of detail. And then performing analytical procedures for accounts receivables and the revenue. I have shown you so many examples when it comes to ARs in revenue. So that is a substantive analytical procedure. This number 4. And then reviewing significant year-end sales contracts for unusual terms. Remember, when it comes to revenue, there can be different year-end manipulations. Maybe because the revenue compensations are linked to revenue recognition, that means target sales and all. But maybe just to show a good revenue sales number, they are manipulating the total revenue figure. So that is why more towards the year end, because by the year end they can calculate the total number and try to see whether they have earned a good amount or not during the period. So if they haven't earned let's say a target amount, they are trying to increase the revenue. That's why you are going to see you are specifically reviewing year-end sales contracts of unusual terms. And this the valuation of receivables, maybe computation of interest income, interest receivables. You are trying to calculate all the receivables when you have non-refundable deposits, refundable deposits, advance payments paid. That means sometimes when you are paying the monthly electricity bill, you have paid 100,000 extra to the electricity board. That means an receivable, right? An asset. So you are going to check the cash payments, any approvals, any correct accounting treatments for those things. Likewise, receivables can be there, rent deposits can be there. So you go and ask the client to give the breakups of all these amounts, and then one by one you go and check whether the amounts are accurate, whether the mathematical accuracy is there, whether they have proper supporting documents for those things. You go and check the rent agreements. Based on the rent agreements, you go and check whether we can actually understand, whether we can actually record this deposit as an asset, or whether this should be recorded as an expense. Likewise, you go and check. And then evaluate the propriety of the client's accounting methods for receivables and revenue. That means the appropriateness, correctness of the accounting method, whether they are actually following SFRS 15 revenue accounting standard, whether there are any issues in their accounting treatment, whether they have misled the fundamentals of revenue. Likewise, they are trying to understand and evaluate accounting estimates related to revenue recognition. Some organizations, especially when it comes to software companies, construction companies, their revenue recognition is inherently risky, as I told you. So they try to record revenue based on accounting estimates. That's not a very straightforward number, but it is an estimation based on the completion percentage, which is also an estimation. They try to calculate the revenue to be recognized. That's an estimate. So you evaluate and go. That means client has done the estimation and they have recorded the revenue. You go and ask for supporting documents how they have come up with this estimates. And then determine the adequacy of the client's allowance for uncollectible accounts. Another name would be allowance for doubtful debts, right? So you are going to check whether the allowance for doubtful debts amounts are accurate, whether they have correctly classified the amounts into baskets, and then whether they have done it correctly. And ascertain whether any receivables have been pledged. Now, this is when it comes to debtor factoring. Factoring of debtors means another financing method. When you have debtors, let's say 1 million worth of debtors, you can actually factor them. That means you can obtain a loan kind of thing over that 1 million debtors. That means you are temporarily, through an agreement, transferring the ownership of that 1 million debtor to a finance company, maybe. And that means that finance company has the right to receive the amounts from the debtors, right? Temporarily in an agreement. That does maybe debtors actually don't know about this situation. Anyway, they have to pay no to the finance company or the company or our company. But the company can receive a bank, not a bank loan, a loan kind of thing over the amounts, over the debtor amounts. You call that factoring. So you go and check whether your client has actually pledged these receivables to another finance company. And then investigate any transactions with the receivables from related parties. That is a very risky area, I would say, because when the companies are trying to give back loans to subsidiaries, related parties, there's a high tendency that the interest rates, the agreements and then the conditions are very favorable to those related parties. That's why we call them related parties. So that is why sometimes they don't have proper agreements for those amounts. Amounts are just lended to the related parties. So you go and check, investigate the supporting documents. Evaluate the business purpose of significant and unusual sales transactions. If there are some unusual sales transactions, let's say towards the end of the year, there's a very high value of sales transaction. You need to go and check the agreement, what has happened, what are the conditions and all when it comes to those things. And then evaluate financial statement presentation and disclosure of receivables and revenue. That is basically when it comes to the financial statements, you go and check the presentation and disclosure. So those are the substantive procedures. Give me a second. Okay, so in this table, I have mentioned now this is taken from a textbook actually. The substantive procedures what we have discussed so far, that those are there in the first column, and then they have mentioned the assertions they are going to cover from each and every test of that means substantive procedures. Just take this one. um, Perform analytical procedures. What are the assertions you are going to cover? Existence, occurrence, and rights and obligations. Confirm receivables with debtors. That means calling external confirmations. You are going to cover existence, occurrence, rights, valuation, accuracy. Likewise, there can be several assertions going to be covered, right? And then another one would be evaluate the business purpose of significant and unusual sales transactions. So, when you are evaluating these high value, very significant sales transactions, you are going to cover the valuation and accuracy of the numbers, obviously, and then presentation and disclosure whether these amounts are correct or not. Likewise, you are going to cover some assertions. So, you can refer to this table to understand them. And another important thing, what you have already discussed, confirmations from receivables. See these points. Now I told you we are calling confirmations from the debtors. That means on the request of the auditors, your client is sending the debtor confirmation request to the debtors because you don't have all the debtor addresses and all. So your client is sending, they have all the details. Client is sending that request letter on behalf of the auditors. And I told you that debtor should reply to the client or the auditor directly. The debtor should directly reply to the auditor, not the client. So I told you those things in the last week lecture as well. So when are we going to call confirmation? So I would say receivables should be confirmed unless accounts receivables are immaterial. Let's say those amounts are very immaterial. And then when you go and inspect the invoice, you can clearly verify that there are no hundreds or thousands of debtors. So the very immaterial accounts receivable value. In that case, you don't have to call confirmations. The use of confirmations would be ineffective. Let's say with the practice, with the past results, auditors know that the debtors are not going to reply, that the debtors are not going to respond, or the debtors are incompetent or they are not in a position to reply. So in that case, no point of wasting time to call confirmations. You will have to do other audit procedures to confirm the numbers. Maybe your debtors are farmers I don't say farmers are not in a position to reply to a letter, but there's a high tendency that they will not care. There are small customers actually. They will not reply to an auditor's letter. They will take it as a burden. So with that mentality, with that attitudes, there's a high tendency that you will not receive any response. So you're not using that. Auditors' combined assessment of inherent and control risk is low, and the audit risk can be reduced to acceptably low level with substantive test. You don't have to call confirmations. You can check the invoice, and that is okay. You don't have to waste time by calling confirmation. So this is where, unless otherwise, you have to collect confirmations. This is the process of confirming receivables actually. Let's say the client in the sense the debtor is ABC company. Amount is 220,000. What is the first step? Confirmation request to ABC company prepared. The company and the auditors together, they prepare the confirmation request. We are sending a confirmation request. We are requesting the debtor to confirm this balance. CPA determines confirmation request is directed to appropriate confirming individual and address. Confirmation request delivered. Now the our confirmation request has been delivered to the debtor. ABC company receives the confirmation request. ABC company confirming party receives and respond to the confirmation request. Now, ABC company is replying to our request. Response is delivered to the auditors. Very important, not to the client, but to the auditors. Response is delivered. CPA receives the response to confirmation request. Now, auditors, they receive the confirmation. So that is how usually the process goes. But there are different types of confirmations. There are different types. Actually, there are two main types of confirmations. First one is positive confirmation. Okay. And the second one is negative confirmations. What do you mean by positive confirmations? That is a request that the confirming party respond directly to the auditor indicating whether the confirming party agrees or disagrees with the information in the request or providing the requested information. That means, let's say, uh, we are the auditors and we have our client, ABC company is the debtor. So, with the help of the client, auditors are sending that confirmation request letter to ABC company. That means we are sending the confirmation request letter. We are requesting the ABC company to respond to this request letter. We are requesting to respond them, confirming whether they agree with this number or disagrees with this number. That means we are mentioning in that confirmation request letter, we are mentioning that as at this particular date, you have to pay this much to this client. That means your overdue balance is 1 million. We are mentioning that amount. So we ask the ABC company to confirm whether they agree with that number or not. Basically, we are asking whether their agreement is there. So agrees or disagrees with the information given in the confirmation request letter. Ordinarily, that means usually we mention that balance 1 million is there. Sometimes we might send blank forms as well. That means blank form in the sense we are not recording that 1 million number because 1 million is as per our records now. As per debtors' records, the number can be different. Sometimes we have dispatched the documents, dispatched the goods, but goods are on the way. So your debtor has not received the goods yet. So they have not recorded the amounts. So there can be situations like that. Sometimes they have paid the amounts. That means they have transferred the amounts to our bank account, but we have not recorded those receipts yet. So we think that 1 million overdue payment is there, but the debtor is saying, no, we have settled 1 million. So there can be differences. So that is why we are asking them. right? So sometimes we are mentioning the amount and sometimes we are keeping the blank form. In that case, we ask the debtor to write that amount. As per your records, what is the amount you need to pay to the client? So both the situations can be there coming under positive confirmations. Anyway, positive means you are expecting a reply. Whether they agree or whether they disagree. Doesn't matter. You are expecting a reply, agree or not. But what about the negative confirmation? The other way of the positive confirmation, that is asking debtor to advise the auditors only if the balance shown is incorrect. That means we are requesting the debtor to reply us only if they disagree with the amount. Let's say 1 million we have mentioned. We are asking them to reply only if they don't agree with that 1 million. If they agree with 1 million, if their records are also saying 1 million is overdue, then they don't have to reply. So that is a negative confirmation. What do you think? In Sri Lanka, positive confirmations or negative confirmations would better suit in this Sri Lankan situation? So definitely positive confirmations, right? Most of the situations we will have to call for positive confirmations. Negative confirmations are very, very risky because we try to think when the debtor is not replying, that means they have agreed with their number. But sometimes they haven't even received the letter. They haven't even checked the number, right? So that is why low level of assess risk of material misstatement. We can use these negative confirmations when the risk is very, very, very low. So actually we are not relying on the external confirmations. That's okay. If even if they don't send, that's okay because we have confirmed the balances already. Or the large number of small balances. When there are small thousands of millions of debtors, sometimes we are asking, okay, if they don't agree, just reply and confirm. If you are agree, just keep it because of the small balances. Maybe a low error rate is expected. That means you have very less number of debtors, but in billions, right? You have, let's say, 1 billion, 5 billion, 10 billion, but 10 debtors are there. You definitely know that these 10 debtors are going to reply you. So if they don't reply, that means they have actually checked the documents and all, they agree. But even if they don't agree with the amount, they will definitely reply us, definitely call us. If that is the scenario, you can obviously go with negative confirmations. No reason to believe that the respondent will ignore the request. If there's no reason to believe that your debtor will not reply, the debtor will ignore the request, then you can obviously go ahead with negative confirmations. So I would say in Sri Lankan context, both confirmations are not suitable, I would say, but positive confirmations are better. We better not use negative confirmations in the Sri Lankan context. Right. And then data analytics. Now, data analytics in the sense when we were talking about test of details and substantive analytical procedures, basically, we can use data analytics, AI, machine learning, trend analysis, all these new developments, IT developments when it comes to SAPs, because it is very easy for us to, especially big data analytics and all, it is very easy for us to understand the trends, to calculate expectations and all. So we can use data analytics in auditing, identify possible fictitious revenue by searching for unusual or large entries. By when you do it manually, you won't be able to identify. But using data analytics, you will clearly understand what are the unusual numbers and all. Identify possible fictitious revenue by searching for entries into revenue accounts from unusual sources. Usually that person is not recording sales because that person is in the HR division. Now, when it comes to data analytics, it will within seconds it will understand the unusual, unidentified sources. And then unusual revenue transactions around year end, because data analytics can track the trends and all. They can identify the trends. What are the possible ways of recording the revenue transactions? So towards the end of the year, there can be some unusually high revenue figures, unusually high revenue transaction numbers. So there can be issues like that. And then identify related party transactions in the sales channel by selecting unusual transactions. And the data analytics can be used to identify possible duplicate billing. Sometimes the same invoice has been recorded twice, more than once, so they can easily track unauthorized sales discounts. When you go and manually check, you won't be able to identify the discount. But data analytics, they can easily, within seconds, identify the sales discount, whether this discount has been approved or not, whether it is a usual percentage. Just let's say we are giving a 10% discount, but if you give 10.2% discount, maybe 10 times, that's a huge number. Let's say that 10% discount is going to the client and that 0.2% is going for someone else. So those are important. When you manually check also, those things we don't capture. So using data analytics, we can identify unauthorized sales discounts and then identify possible uncollectible amounts. When the data analytics techniques are there to understand the behavior of the payments of different debtors individually, that technique can tell you whether this person is going to pay this amount or not, based on the trends, based on the historical analysis. So manually you won't be able to do that, but data analytics would do. And then large credits, you can pick large amounts, large credits from the listings. And then potential revenue recognition problems, I would say, because revenue recognition is very important. Maybe sales with unusual right to return. When you go and check the sales contract, unusually there's a no that is beyond our normal routine conditions. Unusual rights are there to return the goods. So when you have such conditions, you have to be very careful whether you are going to recognize the revenue or not. And bill and hold transactions, that means you are actually billing, but you are not dispatching the goods. You are keeping those sold goods in the same warehouse, maybe in a corner. So that's a very high tendency. You will count those inventories, that means sold quantities, into your inventories as well. So bill and hold transactions. And then multiple element agreements, as I mentioned, when there are several performance obligations to be met, that's another problem, right? Multiple elements are there, then there are potential revenue recognition problems. So as the auditor, you need to be very careful whether the client has recognized these issues. And then evaluating revenue estimates. I told you, when the client has used estimates, you need to evaluate, reviewing and testing management's method of developing the estimates, how the client has actually calculated these estimates. And then we can, as auditors, we go and recalculate our own estimate, that is recalculation, and then reviewing the subsequent transactions. After the accounting estimates, there can be subsequently payments, subsequent returns, and all. So you go and review the subsequent transactions to get the evidences. So auditors are required to perform retrospective review of prior year's significant accounting estimates. That means retrospective means what? You are calculating the estimate, or you are trying to check the accuracy of the estimate, and you go and check whether that has an effect on the previous period as well. If there are issues, you go and change previous year numbers, and then you are changing the current year numbers as well. So retrospective adjustments can be there. Right. And then audit of allowance for doubtful debts. What is this? Now, when it comes to audit of allowance for doubtful debts, I told you we can use the aging analysis. Based on the aging analysis, we can apply some numbers for different baskets, and then you can calculate the allowance for doubtful debts. Basically, you can, after collecting the data, you can review collections in the subsequent period. That means when the client has identified a debtor as doubtful, and if that debtor has actually paid the amounts in the next period, subsequent period means what? Now, if the year is 2025, that means starting from 1st January 2025 to 31st December 2025, subsequent means subsequent settlement, subsequent payments means payments that are happening after 31st December 2025. That means January 2026, February 2026, March, April, before you sign the audit report, right? Subsequent period. So during that period, there can be some payments received. You go and check them, and then you develop, estimate, and evaluate the reasonableness of management's estimate, because doubtful debts calculation is a calculation based on the numbers they have. So, as the auditor, you can, from the beginning with the data, you can recalculate and see whether their allowance for doubtful debts value is accurate or not, reasonable or not. Compare the details of the aging of accounts receivable to prior year aging. You can always take last year aging with this year aging and compare. And investigate the credit ratings for unusually large accounts, whether these if there's one particular debtor with a large amount, you can go and check whether the credit period is 1 month or 2 months or 3 months, or what has happened, why this amount is very unusually high. You go and check that. Review confirmation exceptions for an indication of amounts in dispute. Now, let's say when you call external confirmations from the debtors, you, as per your records, it's 1 million. But the debtor says it's 500,000. So there's a 500,000 gap. So there's a high tendency that this debtor will not agree to pay that 500,000. Maybe a reasonable reason. So you have to consider those external exceptions in the debtor's allowance for doubtful debts calculation, because that will have to be considered in the value you are calculating. And summarize in a working paper those accounts whose collectability is doubtful based on the preceding procedures. Sometimes there's a high tendency that one of your debtors will be bankrupt in the near future. So you understand that that amount will not be collectible. You will have to consider that fact when you are calculating allowance for doubtful debts. And then review with the credit manager the current status of significant doubtful accounts. Now, you can't just say your debtors are doubtful, right? You can't just ignore your debtors saying, okay, this is a doubtful debts. You have to have continuous follow-ups on those debtors, because credit manager is there. That person is responsible to collect the doubtful debts as much as possible before having bad debts, before writing them off. So you need to follow up whether you have to see whether credit manager has taken necessary steps to follow up and get the values, get the amounts to the company. And compute relationships such as number of days sales in accounts receivable and the relationship of the valuation of allowances. That means different analytical procedures can be conducted when it comes to this allowance for doubtful debts. So those are the audit procedures. Okay, the last slide before we wind up. How can we simply calculate a provision for bad debts calculation? Now, I have taken the same basket as I showed you, the aging receivables account. As per this one, now you can see current basket is safe, isn't it? I told you we are putting the numbers in the current basket, saying that these people are not overdue amounts. These amounts are not overdue amounts. These are in the given credit period. So are we going to calculate a provision? No. $108, $108,000, 0%, no provision. What do you think about 1 to 30 days basket? 3,335. They have applied only 10% because there's a low risk in this 3,335 because it is only 1 to 30 days overdue. There's a high chance that they will settle the amounts. That's why we have considered 10%. These 10%, 20%, 50%, these are not universal numbers. These are just company policies, right? So you have to consider the company policies. And then 31 to 60 days, somewhat risky than 1 to 30 bucket. So that is why 1,200 you are applying 20%. And then 18,210, this is the highest risk basket. There's a high tendency that these debtors will not pay the due amounts. That is why we are considering 50% as the provision. So as per your calculations, after considering the reasonableness of these numbers, your allowance is 9,679. But what about the client's computation? Client's calculation on provision for bad and doubtful debts is only $5,000. The client has calculated and said doubtful debts amount is 5,000. But as per our calculation, 9,600. Do you think we need to pass a journal entry? Yes, of course, because the difference is almost 5,000, 4,679, double the amount. That means we need to consider this amount as a journal entry. Client has to pass a journal entry to record this allowance for doubtful debts. Right. So that is how you do a provision for bad debts calculation. What is this auditing procedure? Recalculation. You are trying to recalculate, or you can say reperformance as well. You have performed it from the beginning and you are trying to understand the numbers are correct. Right. So with that, we have covered this lesson. I'm not going to start the new slide today because we have almost reached 8 now. I will quickly give you the OTP. You can mark your attendance, but please make sure you are not marking attendance for someone else because I can clearly get the Zoom report as well. So in the physical lecture, I'm not saying these things. No? So please mark attendance for only yourselves. Give me a second to share the OTP. You can mark the attendance. This is the OTP. Quickly mark your attendance. 842243. Are you all done? Right. I think you have marked your attendance. Okay, Lamai. So thank you very much. I will upload the recording as well. And next week we'll try to see maybe myself or Chinanga sir will be conducting the lecture. Anyway, we'll meet again. Until then, thank you very much. Good night.